I've received hundreds of messages from people asking me to do an episode about this. The Labour government is proposing to tax our superannuation even more. They are proposing a unrealized capital gains tax, which you would have to pay even if you don't sell anything in your superannuation. Labour's tax on unrealized gains could wreck your retirement. This new tax warrants a rigorous scrutiny and a more comprehensive reassessment before it inflicts lasting damage on our nation's financial well-being. The Australian Financial Review suggests that it has unintended consequences. Scary thing is that it's already passed the House of Representatives, but it is not yet legislation. And panic selling has already begun amongst the nation's wealthy. It's already sparked a flight for the exits as wealthy retirees scramble to move their money outside of their superannuation. Let's discuss what this tax really is, what it means positively and negatively for all of us, and most importantly, how it impacts you. The proposal would tax unrealized gains, in other words, increases in your super balance even if you haven't sold any assets, on super balances above $3 million at 30%, starting 1st of July 2025. Now, this legislation may be thrown around a lot, and so if you're watching this episode in 6 months' time, in a year's time, and they've already squashed it, well, that's good, but it may rise again like a phoenix out of the ashes in a new form. So make sure you watch this right till the end, because under the Labour government, new taxes are coming. Let's go through the potential negatives, and then, let's also go through some positives. Believe it or not, there are some. So the first negative is taxation of unrealized gains. Property investors with assets above $3 million, even if they don't sell any of those assets, will face a tax liability every single year as that real estate grows in value. So as the article before suggested, the logical consequence of that is that expensive property, especially commercial property, which is in a lot of instances held in superannuation funds, SMSFs, that is likely to see a lot of forced sales. Very wealthy people often buy negatively geared property to the tune of $1, maybe $2 million in Brisbane, Sydney, Melbourne, or commercial real estate of $1, $2, $3 million, and that becomes their retirement nest egg. It's that kind of real estate. They may have a lot of people selling, therefore the value of it may drop. The second downside is liquidity issues. Now, if you've just made, let's say $100,000 in a single year on either real estate or any other illiquid asset in your super, and now you have to pay 30% tax on those gains, where are you going to get that money from? Especially if they want the super to pay the tax, because that is the entity in which those gains have been made. You'd likely have to sell some of those assets, but if they're illiquid, like real estate, you may not be able to sell it in time to pay your tax. So that puts a lot of people in a big bind. Number 3, all of this complexity may act as a disincentive for people to buy real estate, especially expensive real estate, in their super funds. And I think the biggest unintended consequence of all this is super in the first place was created so that people don't rely on the government to fund their retirement. If the government is putting in their hand and disincentivizing people to build up their super funds, then more people won't actually build their super funds. They'll keep it outside of super. And the human tendency is if you have money to spend, you spend it. Therefore, more people will be reliant on the government when it comes to their retirement. And of course, as we all know, it's unlikely that the $30,000, $35,000 pension that couples receive right now from the government at retirement age, with so much government debt and currency debasement, inflation going through the roof, it's unlikely that $30,000 will even remain, but even if it does and the government can still afford to give that, it's going to be worth more like $5,000 or $10,000 in 20 years' time, adjusted for inflation. So the government's kind of shooting themselves in the foot. They're going to be having to take care of the population if they're disincentivizing the population to take care of itself. Number 4, there's no indexation on this $3 million that's proposed by the government. In other words, sure, you might think, well, PK, right now, $3 million is a lot of money. It kind of makes sense to tax the rich. But in 20 years' time, if this $3 million isn't indexed to inflation, In 20 years' time, 30 years' time, 3 million isn't what it's worth today. It's probably worth in current dollars more like 1 million or 2 million. So you start to see that if it's not adjusted for inflation, this tax is actually a sneaky way not just to tax the rich right now, but to tax everyone, the poor and the rich in the future, but through a schemy means by which the poor and middle class don't realize it right now, and in fact will vote for it. And number 5, I think this is a really scary one, is that governments all over the world, including Canada and the UK, I'm not left nor right leaning, but the leftist agenda is very much to say we want equality, not meritocracy across the population. And so they're trying to, the risk is, to have this unrealized gains tax, not just in super accounts, but also in trust accounts and also in personal held assets. So imagine you have a property worth $500,000 now, and next year or the following year, if this bill gets passed, the Labour government has the social capital to then come out and attack your own personal holdings. Let's say a 500k property goes up to 800k in 2 years. They may come and say, actually, we're going to tax that at 30% too, even if you don't sell it. And all of a sudden, that completely destroys the desire for people to plan for their retirement by investing in assets, not just real estate. This applies to all asset classes: stocks, bonds, real estate, listed investment companies, private equity. And so what you're effectively saying to the population is, we don't want you to become wealthy. Every dollar that you make, both as earned income and capital gains, regardless if you sell it or not, we're going to tax you. And I have nothing against tax. I mean, we need public goods. We need infrastructure, schools, hospitals, etc. But we already know in this country and most parts of the world that the government is the most inefficient entity there is. They waste taxpayers' money. Just look at NDIS as a prime example of something that's blown out. NDIS scheme is just a joke and is making a lot of unscrupulous companies very, very rich at the taxpayer's expense. So you start to get into a dynamic where you have connotations of socialism where no one can actually thrive based on meritocracy, and everyone is having to be brought back down to the lowest common denominator just so that the government is in control. So those are 5 negatives from this proposed unrealized superannuation tax of 30%. A lot of you might be for this, and let's consider 3 favorable arguments. Number 1 is equity and fairness. It only actually impacts 0.5% of super accounts, only about 80,000 people. And so right now, would it be equitable? You could say in one sense of the word it would be, but I've just talked about indexation and the lack thereof. If we're not going to increase this $3 million threshold every year in line with inflation, not wage growth. Wage growth doesn't exist in real terms. If it's not increased in line with not just inflation, which is over the long term is around 3%, but also debasement, currency debasement, which added to inflation is at about 7%. If you're not making 7% return on your cash every year, you're going backwards. If it's not indexed to that, then it starts to impact more and more people. And in 20 years' time, it might impact half of the entire population, including the middle class. The second pro argument for this new tax would be that it helps budget sustainability. We are running budget deficits, and so this helps the government raise more money and take care of the country. Of course, I've already talked about how they try to take care of the country, but mostly just try to take care of themselves first. And I think this new tax doesn't actually apply for members of parliament, which is crazy. But how about this? Instead of taxing your own citizens, why don't you tax big corporations, for example, LNG exporters, iron ore exporters? Why don't you tax the companies that make the most money in Australia by selling their commodities to foreign entities? Taxing 80,000 people initially is nothing compared to being able to tax these trillion-dollar companies or overseas companies like Apple that operate in Australia and pay no tax here. And the third pro of this proposed tax is that it doesn't allow people to defer taxes forever. For example, if you hold a property, you don't pay tax right now on capital gains unless you sell it. But I don't think the majority of property investors in or out of super are trying to evade tax by not selling their property. Rather, a lot of them, especially the smart ones that buy in their super funds, they just want to hold this thing forever because it gives passive income over the long term. So it's not a tax deferment strategy. In fact, the passive income that they receive from that, they pay tax on anyway. So it's not a way to curtail some sophisticated tax evasion approach by wealthy people. In conclusion, I don't think this tax is a good thing. I don't think most taxes in their current state in Australia are a good thing. I am in favor of taxing richer people higher at their incremental highest marginal tax rate. But I think if you want to structurally increase the war chest of the government, why take from people in a struggling economy? Why not help the economy thrive? Because when everyone makes more, then the government will naturally make more. A rising tide lifts all ships. Isn't it better for the economy to increase its productivity rate, which is the lowest amongst its global peers? Therefore, everyone gets richer, including the government, rather than just increasing the slice of the pie for the government at the detriment of everyone else. The biggest risk with this, like I said, is that it's a slippery slope. I know that a lot of people are doing it tough out there, especially the eroding middle class, especially the young people who have no chance anymore to buy real estate unless they start rent vesting. And it's these people that are really Labor's base and are bitter towards those that are wealthy in Australia. But ironically, it's these people that will suffer the most when their own super funds will be impacted due to no indexation in the future. And then when Labor comes after assets in your trust account, your own principal place of residence, and even stocks held in personal names. Like and share this episode. I think everyone needs to be educated about it. I'm not an expert in tax, but it doesn't need an expert to read between the lines of what's really going on in this post-capitalistic economy. My name's PK. Thank you for being with me.